Weekly recap that summarizes more than 72 different news articles in the last week. I'm Micha and I'm bringing you the weekly summary. Are you ready for it? Let's go! Hello, and welcome back to the channel. I'm Micha. Yeah, just Micha, bringing you everything that happened in the stock market or everything that's interesting that happened in the stock market in the last week. Anything that you will see here, as you saw in the disclaimer, is only my opinion, a way to entertain us and to get us to a point where we understand everything that went through in the last week and get us prepared for the week ahead. All the videos that we have are going to be uploaded on our channel, Stock Talk with Micha Stocks, where we have currently 824 subscribers. And if you're new to the channel, welcome. It would be great if you can click the subscribe button and then turn the bell into all. And by that, you'll get updated on anything that happens on the channel with the videos. And the latest video that was uploaded to the channel, which is my conversation with the Einstein of Wall Street, Peter Tuchman, talking about volatility in the market, trading, day trading, stop losses. Very entertaining. Let's start. How do we summarize the week that we had? And we'll start with major averages. The Russell, the IWM, you can see here in the middle of the chart, was down 5%. The NASDAQ, triple Qs, down 3.59%. The S&P down minus 3.3%. And the Dow Jones, with a yellow that you can't probably see, the numbers inside, down 2.72%. When we look at the charts, you can see, and it's quite difficult to see the yellow, I'm sorry for that. The Russell went down the most between the different averages, as you can see, but all of them had a lot of pain during this week. Mainly, it might be caused to tax loss harvesting or waiting for next week, and we're going to talk about what's going to happen next week. This is our heat map. Everything that you see here is from TradingView. It's a website that I use in order to chart and plot what goes on in the market. You can see that the biggest companies in the S&P were red, whether it's Microsoft, Google, Apple, Amazon, Tesla, and a sector that drove a lot of the losses this week was the energy sector. We're going to talk about the sectors in a second. Here you go. Here are the different sectors that are looked at through the lens of the spiders. So the XLE is down 8.45%. The communication service is down 4.8%. And all the rest, no sector was green this week. You can see that energy is for the second or third week going down, trying to take some losses, and the gap between the oil crude and the XLE, the sector itself, is going to be talked about in our top 10. Wait for it. This is how their charts look like. You can see the XLE, and I brought this up mainly to show you the XLE going down from Wednesday or Thursday actually all the way down to Friday. You can see a lot of pressure on the energy stocks, not only on the oil crude and not only on the natural gas, which actually went up this week, but mainly on the assets themselves. And it does provide us with a wall of worry because those were the stocks that actually held up the S&P in the last year. When you look at the 17 most common stocks that our viewer asked for, Shopify was the worst performer, went down 10.87%. And the best performer on the other side of the table is SolarEdge, ticker SEDG, which went up 1.95, but most of the stocks, as you can see, went down. Leading, like I said, was Shopify, ARK, AMD, and Tesla going down. That brings us to our top 10. Are you ready for it? So this is the week in review, the top 10 news articles, news events, the events as a whole that moved the market this week. And we start with number 10. Number 10 this week is the Producer Price Index, or actually number 10 is a lot of data. All the data that next week, or actually this week that will start in the next few days, Tuesday, Wednesday, the Fed meeting, they're going to look at all these pieces of data. And Friday, Producer Price Index was released and it came hotter than expected. The expectation was 0.2% increase and it went up 0.3. It means that the producers are able to bring the prices up, and someone is buying what they're trying to sell or they're trying to produce. But when you look at a longer time frame, you can see that from June, the rate of increases is going down. It's still going up relative month to month, year over year, but it's going down, which means that we have conflicting data. Why conflicting? Because we see that prices are going down. For example, used cars. Used cars peaked during the second half of 2021. And from that point, or actually the first half of 2021, and from that point, they started going down. We are now at a rate of reduction in price. Lots are being filled back up. Sales or reduction below MSRP are becoming more common, which was very far from what happened a year ago or 2 years ago, where the asking price was a lot higher than the MSRPs, which means that we're seeing deflationary effect on the market. Hopefully Tuesday, when we'll talk about the CPI, should bring the CPI even lower than expected. Another data point that shows that inflation has peaked is the gasoline price in the pump. Most of the states in the US right now have lower than $3 per gallon, which means that we are now back to early this year, actually the beginning of the year, which means we went up all the way and came down, which is good. Again, it's deflationary by nature. It's good when you're looking for an inflation to peak. It's not that good when you're looking at other metrics. But for the Fed itself, it is a major event which shows that things are cooling down. When we look at freight rates, we can see that a freight from China to West Coast is down 90%. It relates to less demand. It relates to the inflation peaking. It relates to a lot of things. But at the end of the day, these are good signs that inflation is in the rear view mirror. And from now on, we should see it coming down. Does that mean that the Fed is going to pivot? We'll probably see. Most likely not this month. Most likely not January. But the market is starting to price in, or actually thinking, what are the impacts of the deflation rather than inflation, which was the discussion just a few months ago. Which brings us to number 9. And number 9 is the exact result of everything that happened in the last few months, which is the fear of recession. David Solomon from Goldman Sachs says that there's a good chance of recession. Brian Moynihan, the CEO of Bank of America, says the same thing. We predict a slight recession next year. JP Morgan's Jamie Dimon said that US is in the strongest economy in the world, but, and there's a big but, maybe you should do it with uppercase, inflation could tip the US into recession next year. So a lot of inflationary pressures, and the CEOs of the banks and the investment firms are right now under a lot of pressure, and they're not taking risk. The risk managers, they want to reduce the risk and say there's going to be a recession. It's driven by inflation. We are playing defense. That's what they're doing. It's the easiest thing for them to do is not to take any chances. On the business side, you can see more and more CEOs calling for the Fed to stop hiking and to prevent the US economy into going into recession, which means the difference between a soft landing and a hard landing. A soft landing is avoiding recession. A hard landing is creating a recession. And this is Brian Kirby. Brian Kirby is the CEO of United, which had a very interesting response to a question that was asked on CNBC a few days ago on Tuesday. And they talked to him about recession. And he says, yeah, probably a recession. But actually, he said, if I didn't tune in every morning to CNBC, I wouldn't even know that there is a recession, because when I look at United financials, I don't see any recession. So yeah, he says that there might be a mild recession that's induced by the Fed. Again, everyone is putting their focus on the Fed, and that's why the week that we're going to go into is one of the most important weeks this year. And actually, it's very close to the end of the year anyway, so you can say that it's the most important week of the year. And when you look at Broadcom, one of the biggest telecommunication chip suppliers, their CEO this week, which is a week that they released their earnings, said that overall he's talking to multiple CIOs, at the largest enterprises, and they're not seeing any reduction in their IT spending. So if they're spending, it means that their customers are buying, because otherwise they wouldn't be spending. So is there a recession? Isn't there a recession? Is there a financial crisis? Isn't there a financial crisis? I think the amount of conflicting data out there that doesn't align to the same, let's call it party line, is increasing. And that becomes an issue for the Fed, because any way they will go, there will be people that would say that they went too far or too little, depending on where you are on that discussion. And that brings us to number 8. Number 8 is the combination of a publicly traded company and a privately owned company. But the problem is they're both owned, or actually the most amount of shares owned by the same person, which is Elon Musk. Elon Musk right now took on himself to be the savior of free speech. And I'm saying that with utter respect, but also with a lot of criticism. As the CEO of Tesla, he should be focused on Tesla, but now he's also the CEO of Twitter. And when he adds on his Twitter account this picture that says that he's right now digging all Twitter's darkest secrets, that creates headwind for Tesla, not because of the company itself. We're going to talk about the headwinds for the company itself, but just because if Tesla equals Elon, Twitter equals Elon, the regular math means that Twitter equals Tesla, just because of public perception of Elon. And again, going back to how he incites everyone, and everyone means investors, institutions, and retail investors. Twitter is both a social media company and a crime scene right now. This was posted a few hours ago before recording, and Pierre Ferragu on his Twitter account also mentioned that one of the biggest headwinds right now for Tesla is not actually Tesla, is the fear that the losses that Twitter has and the loans that Elon Musk took would require him to sell more of Tesla shares in order to meet the margin loans or the debt, servicing the debt, which means that there's headwinds for Tesla stock. All that is creating pressure, of course, on Tesla stock. You can see in the last week it went down roughly 6%, which adds to the 50% decline year to date. Now, when you look at the headwinds for Tesla, the company, you can see that China car sales for November are down. And that is a big problem, because if China was supposed to be a growth engine for car companies and Tesla in particular, it creates the headwind that no one was expecting. Part of that was related not to the price, not to the cars, not to production, because actually the Shanghai factory produced over 100,000 cars, this month. It's actually because of the lockdowns. We're going to talk about it in the top 10. Wait for that. But that created a reduction in car sales for all the car manufacturers, which means that it slows the growth of the company. And to that extent, Tesla, without a PR team, did not deny or confirm the article from Reuters that says that Tesla is suspending the Model Y output in Shanghai in the last week of December. Whether it's true, whether it's not true, whether it's producing too many cars, whether it needs to upgrade the line, no one knows, because no one on Tesla team commented on that. And that is a big problem right now for Tesla shareholders, and that's why I'm emphasizing it and explaining, because a lot of retail investors, which probably are seeing this video, are invested this way or the other in Tesla stock. And that brings us to Twitter and the steer pot that goes on and the hot pot that goes on there. So there's Twitter files where Elon Musk is trying to dig out all the skeletons and all the bodies that are buried underneath Twitter and everything that they've done, whether it's Twitter files number 1, number 2, number 3. All this is happening in the last week. And all this brings Elon Musk to a point where he needs to affirm everyone that he continues to oversee both Tesla and SpaceX, but the teams there are so good that often they don't need him a lot. But the thing is that he needs to do those things in order to reassure everyone. There's a lot of discussion about the board, the fact that the buyback isn't done. So Tesla, and I'm not going to elaborate more because I did more than needed this week. there are headwinds. Now, does it mean that the company is not working as it should? It doesn't. But from a stock perspective, we all know how it went down. Now, when you put that into context, I've compared. Year to date, Tesla stock went down 55%. AMD stock went down 54%. Nvidia stock went down 43%. And Salesforce stock went down 48%. The biggest difference between them is that Tesla is supposed to grow 50% year over year, and they're not. But as you can see, tech stocks in general that were high PE are hammered this year. So whether it's Elon or any other CEO, Benioff, or others, everyone's getting hammered. So that's Tesla, and that was number 8. And that brings us to number 7. Number 7 is the Activision Microsoft acquisition deal. Microsoft, it's almost a year ago, or a bit less than that, agreed to acquire Activision Blizzard to grow their Xbox business. And as of this week, the FTC, the Federal Trade Commission, has decided that they would like to block that acquisition, and they're pursuing through court the ability to block Microsoft acquisition of Activision. The reasons for that are the fact that they fear, at least the FTC, that Xbox would gain control of top video game franchising, enabling it to harm competition. Microsoft already approved and agreed to the fact that all the labels from Activision Blizzard will be available for the next 10 years for all the other brands, Sony, Nintendo, and all the others, which means that basically the FTC right now is protecting Sony and Nintendo rather than the regular consumer, because the regular consumer will still be able to consume. And that's why this hearing, or actually this, it's more of a lawsuit because that's the way they need to do it, is kind of strange, and it creates the business climate where no one wants to do any acquisition because FTC would go after anyone else, and it brings Microsoft to a point where they say we can no longer comment on the Activision deal close date. It was supposed to be closed in the first quarter of 2023, if I'm not mistaken. Now they don't know because they're going into a legal fight with the FTC. Both Microsoft and Activision Blizzard want the deal. They want to pursue the deal. And right now, only the FTC is standing in front of them. And that was number 7, which brings us to number 6. And on number 6, we have, yes, we're going back to oil. We're going back to gasoline. U.S. retail gasoline prices are now flat year over year, which is a very dramatic event. As you all remember, gasoline prices at the pump went up and up and up and up and up. And now they're back. They did a whole U-turn from beginning of the year till the end of the year. We're back to exactly where we started. That brings Marko Kolanovic from JP Morgan, the chief strategy for investment, to send out a note on December 8th saying we believe that there is a tactical trade to sell energy stocks right now, the equities themselves. We're going to look at the charts in a second and see why he's saying that. He sees a potential of a significant pullback of 20 to 30% in energy stocks, in the assets themselves. That would represent a great entry point according to their view. This is Marko Kolanovic from JP Morgan. Why is he saying that? He's saying that because when you look at oil crude, this is the chart of oil crude. This is a line chart that shows oil crude. We're back at the prices of the 21st of December 2021. You can see the line chart. If I add to this line the XLE, which is the energy sector, you can see that over time, the oil and the XLE, let me move this way, oil and XLE, oil is a white line shaded by yellow. The XLE is the reddish, purplish, pinkish, whatever the color would be, that follows it. You can see that they usually track one another, meaning that the XLE, the energy stock, and we're going to look at the companies underneath it, the assets underneath it, follows oil. As of July 2022, they separated. As you can see, the XLE went up while oil was going down. It went up, it only made a minor correction, and then it peaked around 15th of November and went down. Now, this gap is the gap that everyone is talking about. The reason that everyone is talking about because it's a huge gap that needs to be closed. And it doesn't matter if it will be closed by XLE going down and oil coming up to it, or oil keep going down and XLE comes down faster. It doesn't really matter. Usually history shows that these gaps are closed this way or the other, and that's what brings Marko Kolanovic and others to be bearish in the short term as a trading opportunity on the energy stocks. Now, does that mean, I remind everyone, this is not financial advice, and whatever they say does not mean that it will happen. All it says that when you look at the XLE holdings, and this is a different website that I'm using called Koifin, shows that ExxonMobil is the biggest holding in the XLE, which holds 23, which has a weight of 23.29% of the XLE. The next one is Chevron with a 19.7% holding in the XLE. And then you go down to the 4% and under, which are Schlumberger, EOG, ConocoPhillips, Marathon Petroleum, Pioneer, Phillips 66, and others. All these have peaked. Schlumberger looks a lot better than all the others. It hasn't broken down yet. You can see the chart above you here. But Chevron has started, as you can see, to break. ExxonMobil has started to break, and that is the situation currently in the energy market. Does it mean that it has to break? No. Does it mean that it will break? No. It means only that Marko Kolanovic right now highlighted as an opportunity for a trade. That brings us to number 5. Number 5 on our list is none other than Taiwan Semiconductors. Actually, talking about Arizona. Taiwan Semiconductors opened last week. Not one, but actually 2 factories, 2 fabs, factories that will produce chips in Arizona. They're going to produce chips for Apple, for AMD, for Nvidia, and others. President Biden was in the event on Tuesday in Arizona, was very proud of the achievement, and as the chip production became a national security issue, a lot of the investment in the chip and in the production of it is going to be built on US soil. You can see the different companies and how much money they would like to invest in bringing it back to the US, whether it's Micron with over $100 billion, Taiwan Semiconductors with over $40 billion, Intel with almost $40 billion, IBM, Texas Instrument, Samsung, and others. These are investments that gets a tailwind from the government that will provide them with coverage and a lot of help from the government, which will produce more jobs in Arizona and other places. That would, of course, help reduce the manufacturing from Taiwan and bring it back to the US, which was one of Biden's biggest biggest achievements in his presidency. And that brings us to number 4. We're getting close to the end. Number 4, Blackstone, the private credit fund, which is focused on real estate, is starting to feel the heat. Will it break first? So, what's the story here? Story is very simple. From the beginning of this quarter, we are now at the beginning of the third quarter of Q4. They have seen a high redemption. Behind the scenes, most of the redemption is probably being done by Hong Kong investors, but it doesn't really matter. Their prospectus says that they have the ability to provide liquidity up to 2% per month and 5% per quarter. They hit the 5% mark as of the first week of December, which means that they need to limit withdrawals. They said that they have never been in a situation where people treated an investment in REITs, in their case, BREIT is their traded REIT, because Blackstone REIT. They've never felt that people trade it as if it was an equity or a stock. But that's the current climate that we are. Everyone is afraid of liquidity. That brought John Gray to CNBC and to explain that they don't have, at least to what he's saying, they don't have a liquidity problem. They're not supposed to go under or anything else. It's just something that they weren't prepared. They weren't prepared for such redemption. Whether you believe it or not, that's the current situation. Will the real estate be the first one to break again and create that pivot for the Fed? Like I mentioned earlier, everyone is waiting for something to create that pivot for the Fed and would release the horses out of the stable to start running and the stocks to go up. Currently, nothing is broken yet. And that brings us to the top three. Number three for this week, we waited. We waited. And unfortunately, it has arrived. Those are the layoffs. The layoffs keep piling up more and more. This last week only, PepsiCo lays off hundreds of its workers. GameStop starts laying off. Pinterest slows down recruiting and cuts the recruiting team. BuzzFeed cutting 12% of their workforce. Adobe cuts 100 jobs. And visualcapitalist.com compiled a visual way of looking at layoffs in 2022. And as you can see, November was a very, very, very dark month when you look at layoffs. Over 59,000 employees. Now, the question that is usually asked when you see this visualization is, why don't we see it in the data? Because jobless claims is not rising in a rapid pace as it should, according to these charts, etc. When you look underneath the surface of the numbers, you see that most of the layoffs are by people that, one, are not claiming unemployment, or some are not claiming unemployment. Second is some get severance payment, and they might be laid off in November, but if they have a few weeks of severance, they can't claim unemployment. That's the second reason. And the third reason is that still the labor market is tight and they're finding other jobs. So yeah, there are hiring freezes and everything that we hear. But at the end of the day, labor market is still very tight and very strong. That is another input for the Fed. And that also frightens the Fed because it induces inflation. Because if someone got laid off and a week later they get a new job, at least at the same pay, if not higher, then that just increases inflation because they're willing to spend. So that was number three, layoffs, which brings us to number two. The one country, 1 billion people in that country, actually a bit more, that we haven't talked about yet is China. Sofia Horta Acosta from Bloomberg updates, no going back. China takes the nationwide step away from COVID zero, allowing for home isolation and reducing tests. This is a dramatic shift in the way the Chinese are looking at COVID. Whether it's going to be something that they're going to stand behind or not, only time will tell. But the pivot that they have done is a dramatic pivot. And whether it's done because of the riots that started, whether it came about because the Foxconn CEO sent a letter to President Xi, whether it happened because they're seeing their economy slowing down to a pace that they've never slowed their growth. It doesn't, and whether it's just a stunt and it's not going to hold, it doesn't really matter. At the end of the day, right now, they're easing a lot of the restrictions. They're easing a lot of the requirements, which provides a tailwind to the Chinese population and their economy. But, and this is a big but, that creates a new problem. The new problem is very easy. End of COVID zero threatens to overwhelm China with infections. As we remember, when no one got yet the vaccine, people unfortunately got ill by COVID, and to that extent went to the hospitals. Hospitals got overwhelmed and too many patients that they couldn't treat. That created a very bad situation. And right now, a research firm says that death may reach 2.1 million deaths just because of that, because hospitals will not be able to deal with all the infections. That brings Larry Summers, which was the former Lawrence Summers, the former Treasury Secretary in the US, to say that he sees a risk of a catastrophic hit to China health system. That's how dramatic this open from 0 to 100, from 100 to 0 is so critical. But at the end of the day, if you're in the stock market, since the beginning of November, when behind the scenes, traders from Hong Kong already understood that is what's going to happen, they have outpaced the S&P by almost 30% in a pace of 5 weeks. Why? Because they went and squeezed the shorts that were on top of the Chinese equities. And as you can see, the orange line, the Hang Seng Index, which is the Hong Kong index, compared to the S&P, which is the blue line, created an alpha of 30% higher in a month and a half. Will it persist? Will it continue? Will there be a pivot? Another pivot. We keep talking about pivots on this video. Only time will tell. But China, no doubt, if it stays open, is going to be a game changer. And that, again, goes back to inflation. It goes back to oil prices. Oil prices will skyrocket again if China opens because they'll consume more oil. That creates that inflationary pressure. On the other hand, they might produce more, which would reduce prices on the other hand. So the Fed has a lot on their plate, which brings us to the one thing, number one for this week. Everyone is talking about it. Everyone has tried it. Everyone has talked to it. And if you are not part of the ones that have logged in, signed up, tried, played around with ChatGPT, then you are missing the most exciting and the most entertaining AI that goes mainstream. ChatGPT is now officially launched, and in the last 5 or 6 or 7 days, it acquired more than 1 million users. As you can see here, it took Instagram 75 days to be at that spot. It took Spotify 150 days. It took ChatGPT 5 days. Relative Google search for ChatGPT skyrocketed and subscribers grew. And you probably are sitting here and saying to yourself, what is ChatGPT? ChatGPT is the large language model trained by OpenAI to assist in text-based conversation. This is ChatGPT. ChatGPT is a website. That is, of course, the interface is a website. And behind it is the most advanced AI based on OpenAI, which is a project that was started or founded in 2015 by Sam Altman and Elon Musk, which left later, and creates or provides the ability to enhance AI to a point where you can have a conversation with a bot and the bot would answer. So, for example, if we want to do that, we can ask him, how do I start trading the stock market? Let's see what it says. I have no idea, by the way, what would be the answer. Let's see what the answer, and here we go. This is live right now while I'm speaking. To start trading the stock market, you will need to open an account in a brokerage firm. Brokerage firms are companies that facilitate, and you can probably read while it's writing. And it's writing, and all I did is ask, how do I start trading this market? Why am I mentioning it as one of the biggest developments happening in the stock market? Because if I take the same question, let's copy it, and go to the most common place we go, which is Google, and do the same thing, this is what I get. I get a few ads. Some might answer, some might not. I get a quick explanation. And then I get more and more and more links on how to do. I get videos, I get everything that I can do versus one person that answers me. And of course, I can keep the conversation, and the conversation is continuous, which means that after I ask that, I can try and say which broker firms. By the way, sometimes I ask him questions and I don't know if an answer would be pulled. Like, what brokerage firms exist for the retail investor? It might not have answers to that because it's not connected to the, oh, here it is. It has the answers. So there are many of brokerage firms that exist for retail investors, including well-known like E-Trade, TD America, Charles Schwab, these firms. And of course, you can continue. You can create your own blog posts. It can help you or your kids with homework. It can create blog posts, emails, email templates, anything you want. It's amazing. Play around with it. ChatGPT, it's called chat.openai.com. Play around with it. And that is the number one. It's going to be a game changer. Hundreds, thousands of startups are going to start, or actually are already founded using these foundations. In the next few weeks, this probably would be the next big bubble. Next week. What are we going to have next week? Well, next week is very exciting. The first thing is CPI, Tuesday. Tuesday morning, we're going to get the CPI, the dramatic CPI that everyone on the Fed will get the numbers, and then they're going to convene. and they're going to talk for 2 days, Tuesday and Wednesday, 13 and 14. And at the end of it, we will get the next rate hike, which would probably be 50 basis points. A lot more interesting would be the news conference after that, where Jerome Powell will stand in front of the news outlets and not only read a written statement, but also answer questions. For example, when are you going to start pausing? How is the pause going to look like? When are you going to start easing? These are the things that everyone is looking forward to. Those are the dramatic events. And when we continue, a few of the companies are reporting as well, like Oracle, Coupa Software, ABM, Weber, Lennar, Trip.com, Adobe, Accenture, and others. We're almost at the end of the reporting cycle. And all that brings us to the end of our weekly recap. So 72 different news articles were, I would want to say, squeezed into this video. I hope you enjoyed it. If you enjoyed it and you're not subscribed yet, this would be a great opportunity to subscribe. Of course, don't forget to smash that like button and to show your appreciation. The only thing that it does is it exposes this channel and these videos to more and more people. If you haven't seen the Einstein of Wall Street, I really recommend it. Would really help you understand better how someone from the trading floor sees the current situation. And by that, all I want to tell you is I'll see you on the next video. Till next time, bye-bye.